Part 1. The Art of Waiting. Why great traders enter when everyone else is already moving. Inspired by the timeless trading philosophy of Jesse Livermore, have you ever noticed something strange about the greatest traders in history? They rarely appear to be in a hurry. While everyone else is rushing to buy before the price moves higher, they wait. While crowds panic and sell everything they own, they wait. While financial television fills every minute with urgent predictions and endless opinions, they remain surprisingly quiet. To the outside world, that patience looks like hesitation. To experienced traders, it looks like wisdom, because one of the hardest lessons the market ever teaches is this: the best opportunity often arrives only after it feels like you've already missed it. That idea sounds completely backward. From childhood, we're taught that success belongs to those who act first. The first investor, the first entrepreneur, the first buyer, the first person to discover the opportunity. But the stock market operates according to a very different set of rules. Being first doesn't always make you profitable. Sometimes, being first simply means you become the person everyone else sells to. Throughout history, countless fortunes have disappeared not because traders misunderstood a company's value, but because they misunderstood time. Timing has humbled brilliant economists. Timing has defeated mathematicians. Timing has embarrassed experts with decades of experience. Because markets don't reward intelligence alone. They reward patience. And patience is far more difficult than knowledge. Imagine standing beside a powerful river. The water moves with incredible force. You know exactly where the river is flowing. Your prediction is perfect. But instead of waiting for the current to reach your boat, you jump into water too early. Immediately the current pulls you under. You struggle. You fight. You waste energy simply trying to survive. Eventually, you climb back onto shore exhausted. Minutes later, the current settles. The water becomes smoother. Now another person steps calmly into a boat. Without fighting the river, they're carried effortlessly downstream. Both people knew the direction. Only one understood the timing. The market works much the same way. Many beginning traders believe success comes from predicting the future. Professional traders know something different. Success comes from recognizing what the market has already decided. That small difference changes everything. Think about how many people spend hours searching for secret indicators. They study economic reports, company earnings, interest rates, breaking news, social media, expert opinions, financial television. They collect information from every direction. Yet despite all that work, many still lose money. Why? Because information without timing is like owning a map but leaving on the wrong day. The destination may be correct. The journey still fails. Jesse Livermore became famous not because he could predict every market movement. No trader can. His lasting lesson was something much deeper. He learned to respect what the market itself was saying. Instead of arguing with price, he listened. Instead of forcing opinions onto the market, he allowed the market to reveal its own intentions. That sounds simple. It isn't. Human nature constantly urges us to act. Waiting feels uncomfortable. Doing nothing feels unproductive. Watching a stock rise without owning it feels painful. Psychologists even have a name for that feeling today: fear of missing out, or simply FOMO. It convinces intelligent people to abandon discipline. It whispers, quote, "By now, if you wait, it'll be too late. Everyone else is making money. This opportunity won't come back." Unquote. Sometimes those thoughts become so loud that logic disappears. People stop following plans. They begin chasing emotions. Unfortunately, markets have a habit of punishing emotional decisions. One of the greatest misunderstandings about trading is believing that action creates profit. Activity feels productive, but activity and progress are not the same thing. Imagine a hunter deep inside a forest. An impatient hunter fires at every movement in the bushes. A disciplined hunter waits, sometimes for hours, sometimes for days. Eventually, one clear opportunity appears. Only then does the hunter pull the trigger. Which hunter do you think returns home with more food? The lesson applies perfectly to financial markets. Every trade carries risk. Every trade consumes emotional energy. Every trade uses capital. The fewer unnecessary trades you make, the more resources remain available when the truly exceptional opportunity arrives. Here's another idea that surprises many investors. Cash is not failure. Cash is preparation. People often believe money sitting in a trading account is wasted. Professional traders see it differently. Cash represents freedom. Freedom to wait. Freedom to avoid bad trades. Freedom to survive uncertainty. Freedom to act immediately when high-quality opportunities finally appear. History repeatedly shows that preserving capital during confusing markets often proves just as valuable as making profits during favorable ones, because surviving difficult periods allows you to participate in better periods later. Many traders forget that simple truth. They believe they must always own something, always trade, always participate, always remain active. But markets don't pay people for being busy. They pay people for being right. And being right often requires waiting much longer than feels comfortable. Imagine planting an apple tree. You water it every day. You protect it from storms. You give it sunlight. Would digging it up every morning help it grow faster? Of course not. In fact, constant interference would destroy it. Yet many traders behave exactly this way. They buy, sell, buy again, change strategies, switch indicators, follow new advice, abandon their plans, repeat the cycle every few days, every few hours, sometimes every few minutes. Instead of allowing good decisions to mature, they interrupt them. Markets require patience much like nature does. Growth follows its own schedule. No amount of worry speeds it up. Another important lesson hides inside every chart. Not every movement deserves your attention. Markets breathe. They rise. They pause. They fall. They recover. Small movements often contain very little information. Large trends reveal much more. Imagine standing close to an elephant. All you can see is its skin. Step back. Now you recognize the entire animal. The same principle applies to charts. Many traders become obsessed with tiny fluctuations. Every candle seems important. Every headline feels urgent. But experienced traders gradually learn to zoom out. The larger picture tells the real story. Noise becomes easier to ignore. Confidence becomes easier to maintain. There's an old saying among experienced investors. Quote, "The market can remain irrational longer than you can remain solvent." Unquote. Whether or not you heard those exact words before, the lesson remains powerful. You might be correct about a company's future. You might understand its products, its leadership, its finances, its competitive advantages, everything. Yet the market may ignore all those facts for weeks, months, sometimes even years. If your timing is wrong, being correct doesn't protect your account. Eventually you discover an uncomfortable truth. The market doesn't pay you for being early. It pays you for being right, at the right time. This realization changes the goal completely. Instead of asking, quote, "What do I think will happen?" Unquote, successful traders begin asking, quote, "What is the market already proving?" Unquote. That single question removes enormous emotional pressure. Suddenly, you no longer need to predict. You only need to observe. Observation is calmer than prediction. Evidence is stronger than hope. Reality is stronger than opinion. And over time, those small differences compound into dramatically different results. Every experienced trader eventually reaches a crossroads. One path is driven by ego. The other is guided by evidence. The ego says, "I know better than the market." Evidence quietly replies, quote, "Let's wait and see." Unquote. The first path often leads to frustration. The second often leads to consistency. Consistency rarely makes headlines. It doesn't create exciting stories. But consistency quietly builds wealth while excitement often destroys it. As we continue, we're going to explore a deeper question. Why do markets seem determined to shake people out of winning positions? Why do so many traders sell moments before prices rise? And why do the greatest professionals appear almost perfectly comfortable doing absolutely nothing while everyone else is busy? The answers reveal one of the oldest secrets in speculation, a lesson that transformed ordinary traders into legendary ones. And once you understand it, you'll never look at market timing the same way again. Part 2, The Art of Waiting. Why great traders enter when everyone else is already moving. Inspired by the timeless trading philosophy of Jesse Livermore. Chapter 4, The Difference Between Prediction and Proof. One of the greatest traps in trading is confusing a possibility with a reality. A possibility is something that could happen. A reality is something the market has already confirmed. Successful traders understand the difference. Unsuccessful traders often do not. A stock can have an amazing story. A company can have incredible products. A business can have enormous potential. An investor can build a powerful argument about why the price should move higher. But the market does not move because something should happen. The market moves because millions of people, institutions, algorithms, and investors collectively decide what happens next. That decision appears on the chart. It appears in price. It appears in volume. It appears in momentum. The market leaves clues. The question is whether we are humble enough to listen. Many traders spend their time trying to prove that they are right. They search for information that supports their opinion. They read articles that confirm their beliefs. They follow analysts who agree with their predictions. They surround themselves with evidence that makes them feel comfortable. But comfort can become dangerous because the market does not reward comfort. It rewards awareness. A professional trader is not emotionally attached to being correct. A professional trader is attached to making the correct decision. Those two things are very different. Imagine a scientist conducting an experiment. The scientist creates a theory. Then the scientist tests it. If the evidence proves a theory wrong, a good scientist changes a theory. They do not argue with the experiment. They do not become angry at the results. They simply accept reality. Great traders must think the same way. Your analysis is a theory. The market is the experiment. Price is the evidence. This is one of the reasons Jesse Livermore became such a fascinating figure in market history. His greatest skill was not simply finding opportunities. His greatest skill was recognizing when the market was confirming his ideas. He understood that a prediction was only the beginning. The market had to prove him right. Without confirmation, an idea was only an opinion. And opinions are expensive when they are attached to money. Think about a weather forecast. A meteorologist may predict that a storm is coming. The conditions may suggest rain. The clouds may begin forming. The wind may begin changing. But would you drive into a dangerous area before the storm actually arrives? Probably not. You would wait for confirmation. You would observe. You would gather more evidence. Trading works the same way. A setup is like a weather forecast. A confirmed trend is like seeing the storm actually arrive. The difference between those two moments can determine whether you survive or suffer. Chapter 5. Why being early can be more dangerous than being wrong. There's a painful truth every trader eventually learns. Being early often feels exactly like being wrong. Imagine buying a stock because you believe it will eventually rise. Your research is excellent. Your reasoning is logical. Your prediction is correct. But after you buy, the stock falls. 1 day, 2 days, 1 week, 1 month, your confidence begins to disappear. You start questioning yourself. Maybe your analysis was wrong. Maybe you misunderstood the company. Maybe everyone else knows something you don't. The emotional pressure grows. Eventually, many traders sell. They give up. They admit defeat. Then something frustrating happens. A few weeks later, the stock begins rising. It moves exactly the way they predicted. But they are no longer invested. They were right about the direction, wrong about the timing. And the market does not reward being almost right. This is one of the hardest lessons for human beings because our minds naturally want to be ahead. We want to discover things before everyone else. We want to find a hidden opportunity. We want to feel smarter than the crowd. There is nothing wrong with searching for opportunities. The mistake is believing that discovering something early automatically means we should act immediately. Sometimes the greatest advantage is not seeing something first. Sometimes the greatest advantage is waiting until everyone can see it. Consider a mountain climber. Before climbing, an experienced climber studies the weather. They check the conditions. They examine the route. They prepare their equipment. A beginner might say, quote, "Why are you waiting? The mountain is right there. Let's go," unquote. But the experienced climber understands something important. The mountain will still be there tomorrow. A missed opportunity is often temporary. A bad decision can be permanent. The same principle applies to trading. There will always be another opportunity. There will always be another stock, another market cycle, another trend, another chance. But your capital is limited. Your emotional energy is limited. Your time is limited. Protecting those resources is part of becoming a serious trader. Chapter 6. The market is a teacher, not an enemy. Many traders develop the wrong relationship with the market. They see the market as something to defeat, something to conquer, something to outsmart. They imagine themselves fighting against other traders, institutions, or some invisible force controlling prices. But this mindset creates unnecessary conflict. The market is not your enemy. The market is your teacher. Every movement provides information. Every rise, every decline, every period of uncertainty, every unexpected reversal. The market is constantly communicating. The question is, are you paying attention? Imagine sitting across from a wise mentor. This person has decades of experience. They have watched thousands of mistakes. They have seen every emotional reaction. They understand human behavior. Now imagine arguing with that mentor every time they give you advice. Eventually, you would stop learning. The market works the same way. When the market tells you that your idea is wrong, listen. When the market confirms your idea, listen. When the market provides no clear message, wait. The trader who listens has an advantage over the trader who demands that reality follow their opinion. One of the most expensive mistakes in trading is holding on to a losing position simply because you want to be proven right. This is not investing. This is emotional attachment. The market does not know your purchase price. It does not know your hopes. It does not know how much research you completed. It only reflects supply and demand. The price does not care about your feelings. And although that sounds harsh, it is actually one of the most freeing lessons a trader can learn. Because once you accept this truth, you stop fighting reality. You begin working with it. A farmer cannot demand that crops grow faster. A sailor cannot command the ocean. A pilot cannot control the weather. They can only understand conditions and respond intelligently. Trading is the same. You cannot control the market. You can only control your preparation, your patience, and your decisions. Chapter 7. The power of waiting for crowd to reveal itself. One of the most fascinating things about markets is that human emotion creates patterns. Fear, greed, hope, panic, excitement. These emotions repeat throughout history. Technology changes. Companies change. Markets change. But human psychology remains remarkably consistent. This is why lessons from traders like Jesse Livermore continue to matter today. The names change. The companies change. The numbers change. But the emotions remain the same. At the beginning of a major trend, most people do not believe it. They doubt it. They question it. They wait for more proof. Then the trend continues. Slowly, more people notice. The news begins discussing it. Analysts begin explaining it. Investors begin participating. Eventually, what seemed uncertain becomes obvious. This is where patience becomes powerful. Because the best traders are not trying to predict every movement before everyone else. They are waiting for the market to reveal itself. There's a difference between being late and being patient. Many people confuse the two. Being late means missing an opportunity because you ignored it. Being patient means waiting until the opportunity becomes stronger. A professional trader may not capture the first part of a move, but they may capture the safest and most reliable part. They trade a little certainty for a little less potential profit, and that is often a very intelligent exchange. The beginner asks, quote, "How can I buy at the exact bottom?" Unquote. The professional asks, quote, "How can I participate in a meaningful trend while protecting my capital?" Unquote. Those questions lead to completely different decisions. Chapter 8. The emotional battle inside every trader. The biggest battle in trading is not between buyers and sellers. It is between discipline and emotion. Every trader has an internal voice. That voice creates urgency. It says, quote, "Do something. Don't miss this. Get it now. Take action." Unquote. But successful traders learn that not every voice deserves to be followed. Sometimes the strongest move is refusing to react. Sometimes the smartest decision is waiting. A chess grandmaster does not move every piece quickly. They pause. They study. They consider possibilities. They wait for the right moment. A beginner may move quickly because they are excited. The expert moves carefully because they understand consequences. Trading is similar. Speed creates activity. Patience creates opportunity. The market rewards emotional control because Emotional control is rare. Many people can analyze a chart. Many people can learn technical indicators. Many people can study financial statements. But very few people can sit quietly while everyone else is acting. That ability is a genuine advantage. Part 3. The Art of Waiting. Why great traders enter when everyone else is already moving. Inspired by the timeless trading philosophy of Jesse Livermore. Chapter 9. The market's greatest trap, the false move. One of the reasons trading is so difficult is because the market does not reveal its intentions immediately. It tests people. It creates uncertainty. It creates moments where emotions become stronger than logic. Many traders believe the hardest part of trading is finding an opportunity. But often, the harder challenge is knowing when an opportunity is real, because the market creates many false signals. It creates movements that look powerful but disappear. It creates breakouts that attract buyers before reversing. It creates declines that convince people to sell before recovering. These moments are not unusual. They are part of the natural behavior of financial markets. Imagine standing at a starting line, watching a race. The runners prepare. The crowd becomes excited. The signal sounds. A few runners jump forward. Everyone believes the race has started. But then they discover it was only a false start. The real race has not begun. Markets behave similarly. A price movement is not always the beginning of a new trend. Sometimes it is simply a test. The market is asking, quote, are buyers truly committed? Are sellers truly exhausted? Is there enough strength behind this move? Unquote. This is why confirmation matters. A professional trader does not become excited simply because a price moves. They ask deeper questions. Why is it moving? Who is participating? Is the movement supported by strength? Does the market continue proving the same message? A single day can create an illusion. A sustained trend creates evidence. Chapter 10. Why most traders enter at the worst possible moment. Human psychology creates a strange pattern. People often become most interested in something after it has already moved significantly. Think about everyday life. When a house price rises dramatically, more people suddenly want to buy. When a stock becomes popular, everyone starts discussing it. When a trend becomes obvious, the crowd arrives. But by the time something feels completely safe, much of the opportunity may already be gone. This is where emotional decisions become dangerous. People often enter because they feel comfortable. But comfort and opportunity are not always the same thing. The beginning of a trend usually feels uncertain. The middle of a trend feels more convincing. The end of a trend often feels exciting. Unfortunately, many people enter during the excitement. They wait until everyone agrees. They wait until the news is positive. They wait until the story is everywhere. Then they buy, not because the opportunity improved, but because their fear disappeared. Great traders learn to separate emotional comfort from quality opportunity. They understand that the best decisions often feel uncomfortable. Buying after confirmation can feel late. Selling after weakness appears can feel early. But discipline requires accepting temporary discomfort in exchange for better decisions. Chapter 11. The importance of price, time, and confirmation. A price movement by itself tells only part of the story. Time completes the message. A sudden move upward for 1 hour can be exciting, but excitement is not confirmation. A move that continues day after day demonstrates something different. It shows commitment. It shows participation. It shows that buyers or sellers are willing to maintain pressure. Think about a person making a promise. Anyone can make a promise once, but repeated action reveals character. Markets are similar. One strong day is a statement. Several strong days become evidence. Time separates temporary emotion from lasting conviction. This principle protects traders from chasing every movement. A market full of constant excitement creates many opportunities that are not real, but patience allows false moves to reveal themselves. The trader who waits allows the market to do the hard work. Instead of guessing, quote, will this move continue? Unquote. They observe, quote, has this move already proven itself? Unquote. Chapter 12. The hidden advantage of doing nothing. One of the most misunderstood skills in trading is inactivity. People admire action. They admire someone making trades. They admire constant decision-making. But experienced traders understand something different. Sometimes the highest quality decision is no decision. A professional investor can sit through days, weeks, or even months waiting for the right conditions. This does not mean they are lazy. It means they understand opportunity. A hunter who waits quietly is not inactive. They are prepared. A surgeon who waits for the correct moment is not afraid. They are careful. A trader who waits for confirmation is not missing opportunities. They are protecting themselves. The market creates endless possibilities, but not every possibility deserves participation. The goal is not to trade more. The goal is to trade better. Chapter 13. The transfer of wealth from impatient to patient. Throughout market history, money often moves from those who cannot wait to those who can. This is one of the oldest patterns in speculation. The impatient investor buys because they are excited. They sell because they are afraid. The patient investor watches, studies, waits, acts when the conditions are favorable. During market declines, fear increases. People who once felt confident suddenly lose confidence. They begin questioning everything. Eventually, some investors sell simply because they cannot tolerate the emotional pressure anymore. They are no longer making decisions based on opportunity. They are making decisions based on pain. This is why market turning points often happen when emotions reach extremes. Not because the crowd is always wrong, but because emotion can become disconnected from reality. The patient trader understands this. They do not rush into panic. They observe. They wait. They look for evidence that pressure has changed. Chapter 14. Building the mindset of a professional trader. The journey from beginner to professional trader is not only about learning strategies. It is about changing identity. A beginner thinks, quote, I need to find the next winning trade. Unquote. A professional thinks, quote, I need to protect my ability to participate. Unquote. A beginner thinks, quote, how much can I make? Unquote. A professional thinks, quote, how much can I lose? Unquote. A beginner thinks, quote, I need to predict. Unquote. A professional thinks, quote, I need to respond. Unquote. This transformation is difficult because it requires humility. You must accept that you will never know everything. You must accept that the market will surprise you. You must accept that being wrong is part of the process. The goal is not perfection. The goal is discipline. Part 4. The final lesson. Timing is the difference between knowing and profiting. Chapter 15. Analysis finds opportunity. Timing creates results. Research matters. Understanding businesses matters. Studying markets matters. But analysis alone does not create profit. A great idea at the wrong time can still produce a painful result. A good company can be a bad investment if purchased at the wrong moment. A weak company can sometimes rise because the market environment supports it. This is why timing matters so much. Fundamental analysis answers, quote, what should happen? Unquote. Market timing answers, quote, when is the market ready? Unquote. The strongest traders understand both. They respect the business, but they also respect the chart. They understand the story, but they also understand the evidence. Chapter 16. The final transformation. Becoming a student of the market. The greatest change happens when traders stop trying to control the market. The market does not need your approval. It does not need your prediction. It does not need your agreement. It simply moves. Your responsibility is to understand. The market speaks through price. It speaks through momentum. It speaks through behavior. Every day it offers lessons. Some lessons are profitable. Some lessons are painful. But every lesson provides information. The question is whether we are willing to listen. The trader who listens becomes adaptable. The trader who refuses becomes trapped. Because the market rewards flexibility. It rewards patience. It rewards discipline. Chapter 17. The power of waiting. Perhaps the greatest lesson of all is simple. Waiting is not doing nothing. Waiting is preparing. Waiting is observing. Waiting is protecting your future opportunities. The best traders are not always searching. They are watching. They are learning. They are waiting for the moment when preparation meets opportunity. The market will always create another chance, another trend, another opportunity, another cycle. You do not need to capture everything. You only need to recognize the moments that truly matter. Closing message. If there is one lesson you remember from this video, let it be this. The market does not reward the person who arrives first. It rewards a person who arrives prepared. The greatest traders in history understood something that most people never learn. Patience is not weakness. Waiting is not fear. Confirmation is not hesitation. These are weapons. They protect your capital. They protect your confidence. And they allow you to participate when the odds are finally in your favor. If this message changed the way you think about trading, share your thoughts in the comments. What is one lesson about patience that you will apply to your own trading? Remember, the market will always be there tomorrow. Your capital does not have to be. Protect it, respect the process, and let the market prove itself. Thank you for watching.